I'm Mijun from the University of Launch in the United States. January 5th. Let's start today's Big Jew City news. Welcome to Mijun, who consistently sticks to the basics of investing in United States stocks. Mijun. Dear Bemere viewers, how did you spend the first weekend of 2026? Usually, at the end of the year, there are a lot of appointments and various events to attend, so you end up feeling quite exhausted. So, I think many of you probably spent the first weekend of the new year relaxing and taking a good rest. My weekend was similar too. Of course, I was busy until Saturday. As many of you know, on Saturday morning, I held an event with Chief Executive Officer Kim In-jung of Choilsak to reveal the top 6 stocks of interest for the first half of 2026. This live broadcast set a new record. As you can see, the broadcast lasted 1 hour and 58 minutes, so I thought it might have been the longest broadcast in the history of Mijun Live. But as those of you who joined the broadcast know, Chief Executive Officer Kim In-jung is currently having a hard time because he is experiencing facial paralysis. So even though it was a very difficult situation for him to participate, it seems he really wanted to join us because this was such an important event. So he pushed himself a bit too hard. For 2 hours, despite his discomfort, Mr. Kim In-jung joined us to analyze the stocks of interest for the first half of the year. I want to take this opportunity to thank him once again through this broadcast. Thank you for watching even though you're not feeling well. I hope you recover quickly. We sincerely hope that you will come to our popular United States Stock Elementary School and give a wonderful lecture. Alright, then wishing Mr. Kim In-jung a speedy recovery. Let's start today's big stock news for January 5th right away. Today is the Monday broadcast. We'll start by briefly reviewing the United States stock market trends from the past week. I've changed the S&P 500 trading time to 1 week. As you can see, red is overwhelming green. Especially most of the tech stocks we love didn't do well, but among them there were a few stocks like Advanced Micro Devices Intel and Micron Technology that surged. But overall, the atmosphere wasn't good for tech stocks, so we can sum it up like this. If you actually look at the index movements over the past week, the Nasdaq 100 was the weakest index for the week. So, tech stocks, especially the larger ones with big market capitalizations, had the worst stock price performance. They showed a downward trend. Afterwards, small cap stocks fell 1.43 and microcaps, the smallest stocks, dropped 1.23. The S&P 500 fell by 1.03, so the Santa rally hasn't actually happened. By the way, today is the last day of the Santa rally. So if we don't see a surge of over one today, it looks like Santa won't be coming this year either. In the history of the United States stock market, there has never been a year when Santa didn't come for 3 years in a row. So there's some hope that maybe the United States stock market will surge today and Santa will show up after all. This chart shows the performance by sector. There was one sector that surged in stock price over the past week, and that was energy. The energy sector jumped by as much as 3.28%, which is a significant increase. Utilities closed up 0.94%, industrials were up 0.49%, and materials finished up 0.02%. But what about the other sectors? They were all in the red. Our beloved tech stocks were down 1.52%, and consumer discretionary, with Tesla and Amazon dropping significantly, led the decline with a 3.03% drop. But the encouraging part is, the map you're looking at shows just one day's performance from last Friday. It was okay for the day. Green is dominating the map. Especially the semiconductor sector that we care about performed really well. First, AI beneficiaries mean semiconductors, and the other is software, right? But on the other hand, software stocks fell. What does this mean? As we start 2026, investors are still counting on AI. But among the AI beneficiaries, there are some that are performing really well. This means some semiconductor stocks are meeting expectations based on current earnings results. Thus, Stocks with proven earnings have risen in price since the start of the year. However, software stocks that are only driven by expectations and have not yet backed it up with earnings are generally showing a downward trend. This is how we can sum up the market sentiment at the beginning of the year. Mijuan, the top pick, was excellent. With Ethereum and Bitcoin also surging, most of Mijuan and the top picks showed a sharp upward trend. If you look at the very top, Bitmain went up 10 and 17 over the week. On Friday alone, it surged by 14 and 8. Secondly, Micron technology is amazing. On Friday alone, it showed a sharp upward trend of over 10, and its 1-month return is marking 32. Thirdly, on Friday, the exchange-traded fund tracking Ethereum surged by 9.98. Talon Energy rose 5.84. Taiwan Semiconductor, Manufacturing Company 5.17. B2 5.07. Persla 5.02. Coinbase 4.59. And Advanced Micro Devices 4.35, showing sharp upward trends for Mizone and the top picks overall. Were there any stocks that showed a minus on Friday? Credo fell 0.47, Meta dropped 1.47, Tesla declined 2.59, and Palantir from the software sector plunged 5.56. As we start a new week today, I thought carefully about which article I should read to you that would be the most helpful. Since it's the beginning of the year, I think this is probably the time to make your investment plans for the year. For 3 years, our portfolio has included stocks that gain from artificial intelligence. So, at this point, the question we have is whether stocks that benefit from artificial intelligence are still valid, or if we should start broadening our investment scope and shift our focus to other sectors. It's something we're really considering. As you know, our portfolio is still mainly composed of stocks that benefit from AI. If I were in your position, I think I would be really afraid of an AI bubble bursting. I had some free time at the end of the year, so I watched various videos. Recently, there have been a lot of messages warning about an AI bubble and some rather frightening messages that instill fear, especially on YouTube. So, for those who feel anxious while investing in AI beneficiary stocks, I'd like to share a good article along with my personal message. First, let's read an article on future AI beneficiary stocks. As artificial intelligence trading continues to push the stock market to all-time highs, more and more investors are asking whether we're living in yet another financial bubble that's destined to burst. The S&P 500 rose 16% in 2025. Nvidia, Alphabet, Broadcom, and Microsoft, all AI beneficiaries, led the gains. However, at the same time, concerns are growing about the hundreds of billions of dollars that big tech companies have pledged to pour into AI infrastructure. What are the capital expenditures for Microsoft, Alphabet, Amazon, and Meta? It is expected to increase by about 34 more in 2026, reaching a total of approximately $440 billion. Now, whether they can actually spend such astronomical amounts, and if they do, whether it will lead to improved performance, is causing a lot of concern among investors. That's how you should see it. It's about AI. OpenAI has promised to spend over $100 billion on AI infrastructure. So what does that mean? OpenAI is still an unlisted company that hasn't made a profit yet. But since it's not a megatech company and it's an unlisted company saying it will spend $100 billion, it's a hard number to believe. One more thing that's concerning is the cyclical structure of investments and spending between OpenAI and some of the big listed tech giants. Well, as you all know very well. A prime example is the investment and spending between NVIDIA and OpenAI. NVIDIA invests a significant amount of money in OpenAI. Now, with this investment, OpenAI buys NVIDIA's GPUs, so the money just goes back and forth like this, and there are criticisms that there's no real growth. But if this works out well, when things are stable, it's for OpenAI's development. If it takes 3, 4, or 5 years, there's a possibility that with NVIDIA's huge investment, things could suddenly surge temporarily. As growth accelerates, this kind of cyclical structure of investment spending could speed up the overall growth of the AI ecosystem. can we look at it positively like this? But for these positive expectations to come true, in the end, OpenAI needs to do well. So, for now, these are still unlisted companies, and companies without capital, sales, or profits. If they suddenly grow rapidly through this structure, start making profits, see a surge in sales, and generate net income, then in the end, this cyclical structure will be considered a success, right? That's why we should focus on this and consider investing in AI beneficiary stocks in 2026. Brian Levitt, the chief global market strategist at Invesco, appears. When there is technological progress that changes society, overinvestment has historically been a common theme. So, whenever such major technological advances appear, he says that overinvestment has always happened. For example, this occurred with railroads, electricity, and the internet. So this time as well, he says that overinvestment is inevitable and a bubble is bound to form. At some point, the speed of infrastructure development might temporarily exceed what the economy needs, so there could be overinvestment and surplus infrastructure. But even so, it's not like the railroads weren't completed or that the internet didn't take hold in the world. So just because a bubble forms doesn't mean that the technology isn't needed. Just because there's a bubble in artificial intelligence doesn't mean AI can't continue to develop. We shouldn't think that way. But from an investor's perspective, it's different. That's because we need to know when the bubble will burst in order to properly reduce our investment. So as stock valuations rise and the S&P 500 posts double-digit returns for 3 consecutive years, investors are wondering how much upside is left. And if AI investments fail to meet expectations, investors can't help but worry about how much market value could disappear. That's the situation. Recently, 6 companies, including Nvidia, make up nearly 30% of the S&P 500's market cap, making the market much narrower. Therefore, if there is a sell-off in AI stocks, the overall index will inevitably take a big hit as well. Gene Goldman, the chief investment officer of Sarita Financial Group, appears. Gene Goldman says, "Those who don't believe AI stocks are in a bubble usually point out that bubbles tend to burst in a bear market, and we don't see a bear market coming anytime soon." This statement is half right and half wrong. Bubbles burst in a bear market because they are bubbles. So it's true that AI is rising as a bubble. But what's important isn't whether it's a bubble or not. What matters is when this bubble will burst. And as correctly pointed out here, the AI bubble will eventually burst when a bear market comes. This is the part we need to pay attention to. Now, if you look here, you can see a chart comparing the current AI boom with past market bubbles. There have been a lot of bubbles. If you look here, there was a bubble in the 1920s, and it ended with the Great Depression. There was also the Nifty 50, the Black Monday crash, the bubble in Japan, the dot-com bubble, and the Saudi Arabia stock bubble, the China A-share bubble, and the tech disruptor bubble. This refers to the growth stocks that Cathie Wood was heavily investing in. Even in the United States, there was a period between 2020 and 2021 when heavy investment in these stocks led to a crash. And as you all know, the Facebook, Apple, Amazon, Netflix, and Google stocks also experienced a significant drop during the 2022 bear market. Anyway, looking at the overall history of these bubbles, on average, a bubble lasts about 2.55 years. That's why the current AI bubble has seen stock prices rise for about 3 years. In a way, you might start to feel uneasy, thinking that it could burst soon. But if you look next to that, on average, bubbles see stock prices rise by about 244% during the bubble period. That's based on the S&P 500, but the current AI bubble has only risen by 131% so far. So, it still has a long way to go before it can reach the average bubble's gain or return. So, since it hasn't gone up much yet, there's a logic that says this bubble still has a long way to go. That's why Michael Hartnett from Bank of America says this. He advises caution about leaving the market because the last phase of a rally or the last phase of a bubble is usually the steepest. He adds that buying cheap value stocks like those in the United Kingdom or energy companies could be a way to hedge. As investors, we shouldn't fear a bubble, since only then will our AI beneficiary stocks surge. I'm investing mainly in AI beneficiary stocks, expecting these stocks to double or triple in the future. But if you feel too anxious and nervous, then you can just increase your cash holdings. But what's important is you shouldn't leave the market, because you need to remember that the most prominent gains usually happen right before a bubble bursts. Now, what is this second graph here? It's the ratio of the top 10 stocks, meaning the stocks ranked 1st to 10th by market capitalization, to the total market capitalization in the United States stock market. Right now, it's making a U-turn and rising significantly. This means the market concentration is increasing and the breadth is narrowing. That's how you should see it. The top 10 S&P 500 stocks now comprise about 40% of the index, and this level hasn't been seen since the 1960s. There has never been a time when just a few stocks have dominated the market capitalization like this. Now, however, historians say, they note that in the early 1900s, 63% of United States market value was in railroad stocks. So today's tech dominance isn't unusual. Such concentration often occurs during bubbles. In the early 1900s, during the railroad stock boom, up to 63% of the entire market was invested in railroad stocks. We can take a look at these historical facts. Next is the fundamentals, and this part is very positive. How do today's AI beneficiary stocks compare to the dot-com bubble? Their debt-to-earnings ratio is low, indicating little debt, but I feel this interpretation is somewhat misleading. The key point is many companies currently have little debt relative to earnings. And also, companies like Nvidia and Meta are already showing strong profit growth through AI, which is different from the speculative era 25 years ago. During the dot-com bubble, the problem was that there weren't many companies actually making money with dot-coms. So there are quite a lot of differences compared to now, and we need to focus on this point. Now here's the problem. In 2026, Meta, Alphabet, and Oracle are set to raise $56 billion in funding. Therefore, there is also caution regarding credit risk, and now the megatech companies are finally starting to raise funds. That means their cash flow alone isn't quite enough, so they're starting to take on debt. This means they're using leverage, which often drives stock prices up when growth accelerates. But if the bubble bursts, stock prices can fall sharply. That's the key point. Next is valuation. This is the famous Shiller Per, and as you can see, it went up to here during the dot-com bubble before it crashed. If you look here, it's not at that level now, but you can see that it has risen quite a lot. The Shiller Per of the S&P 500 has risen to its highest level in history, except for the early 2000 SE. However, compared to Cisco's PER, which was over 200 times in 2000, the current top stock, Nvidia, doesn't even reach 50 times. Therefore, there is also an optimistic view that the pace is much more moderate, and you can see it this way. I've written down what the Shiller Per index is for your reference. It's the current stock price divided by the average earnings over the past 10 years, and the average earnings are also adjusted for inflation. What this means is that the Shiller Per divides the current stock price by the average earnings over the past 10 years. So, you can see it as a mechanism to reduce numerical distortions that occur when a company's earnings temporarily surge or plummet in a particular year. Personally, I don't really trust the Shiller Per. The reason is, as you can see here, it averages out a temporary surge in a company's earnings in a particular year. I don't think that's necessary. Because artificial intelligence is evolving with the times and undergoing structural growth, it doesn't accurately reflect these changes and this era's evolution. Therefore, I think just using PAR instead of Shiller Per is a more accurate way to measure valuation. Now here is a graph that shows the caution of investors. Suddenly, you can see a sharp rise here. This graph shows how many people are talking about the AI bubble and the frequency of those discussions. By late 2025, talk of an AI bubble increased, leading to poor performance for AI beneficiary stocks in Q4 2025. In November alone, articles mentioning AI bubble matched the total from the prior 10 months combined. So, in so many articles, there were talks about the AI bubble and how the AI bubble would burst, and it wasn't just in newspaper articles. As I mentioned earlier, it's the same with YouTube videos. Everyone is using sensational titles and sensational content, stirring up fear about the bubble. That's how you can see it. In Bank of America's December survey, investors also cited the AI bubble as the biggest tail risk. More than half of the respondents said that the Magnificent Seven is the most crowded trade on Wall Street, and right now, too much money is concentrated in the Magnificent Seven. That's how people are responding. Now Venugopal Krishna, the head of United States equity strategy at Barclays, appears. He has something very important to say. Unlike the blind excitement during the dot-com era, there is now a healthy skepticism and scrutiny about whether AI investments will actually lead to profits. Therefore, it is being analyzed that this will actually help prevent extreme movements like a market crash. I feel the same way about this as well. We keep looking at the market sentiment index, right? So, whether it's the fear and greed index or the results of AI and AI surveys, right now there's a bubble. And it seems like there are a lot of people who are trembling in fear. Right now, we're just in the early stages of a bubble forming. Later, when everyone feels euphoria, when everyone insists that AI beneficiary stocks will keep rising, that's likely to be the peak. That's how you should see it. I'll wrap up with a word for Mijon. I'd like to share some very interesting research results with you all. In the table above, the order in which the bubbles burst was listed, right? There were about 10 of them. But I did some research to see if, during the periods when these bubbles burst, the Fed had entered a rate hiking cycle, or if there were cases where the bubbles burst even though the United States didn't fall into a recession. I'll show you the results. First, let's talk about the Roaring Twenties. From 1926 to 1929, the stock price increase was a whopping 153%. At that time, the Fed was in a rate hiking cycle. At the start of 1928, the base interest rate was 3.5%, rising to 6% by August 1929. In 1929, the market peaked, and then the United States stock market collapsed. There was no recession before because the economy was booming. That's the perspective to take. So the Roaring Twenties, you can see that the interest rate hike was the direct cause of the bubble burst. The second is the Nifty 50. It's called the Nifty 50. From 1966 to 1972, the market soared by 153%. Now, the reason for the sudden stock price crash at this time was also the Fed's interest rate hike. In the late 1960s, they began to respond to inflation. From 1968 to 1969, the Fed's benchmark interest rate surged from 3 to 9%. A recession also occurred, starting from 1969 to 1970. So, in conclusion, the reason the Nifty 50 collapsed was because interest rate hikes and a recession happened together. That's how we can sum it up. Now, the third one is the famous Black Monday. Black Monday. Before the crash happened, stock prices went up by as much as 111%. The period was about 2 years. From 1985 to 1987, the market surged. Back then, before Black Monday came, the Federal Reserve also started a rate hike cycle. In 1986, from the mid-20s, the rate hikes began. In early 1987, the base interest rate was 5.875, but rose to 7.25 by September. There was no recession. In conclusion, the collapse resulted from the interest rate hikes. The fourth is the Japanese stock bubble. Between 1986 and 1989, the stock market soared 149% in 3 years. Now, at this time as well, interest rate hikes started in May 1989, so that was the peak. Interest rates rose from 2.5% in early 1989 to 6% by August 1990. They couldn't handle it, and that's the point. Japan's economy was booming, but ultimately, the interest rate hike was the key trigger for the bubble burst. That's the conclusion we can draw. Now, next is the famous dot-com bubble. From 1998 to 2000, the Nasdaq surged, and during this time, interest rate hikes started in June 1999. The interest rate, which was only 4.75%, rose to 6.5% by May 2000. And there still hasn't been a recession. The collapse was caused by interest rate hikes, but the recession came a year later, which is why the dot-com bubble lasted so long. First, it collapsed from interest rate hikes, then again when the recession hit. That's how you should see it. This is the Saudi Arabian stock bubble, which surged 316% from 2004 to 2006. Saudi interest rates also tracked the United States Federal Reserve's rates. United States interest rates were about 1%, but by 2006, they had jumped to 5.25%, over 5 times higher. That's why, even though Saudi Arabia's economy was booming during those 5 days, the stock bubble burst due to the interest rate hikes. That's how you should see it. The seventh is the China A-share bubble. From 2005 to 2007, stock prices soared more than sixfold. During this period, China's interest rates also went up. From 2006 to 2007, there were 6 interest rate hikes. After 6 rate hikes, the market crashed. The interest rate jumped from 5.58 to 7.47, causing the A-share bubble to burst. You can look at it this way. At that time, interest rates rose and regulations tightened, but there was no internal economic recession, correct? The most recent example is the tech disruptive innovation stock rally. From 2020 to 2021, it went up by 384% over 2 years. The most representative investor was Cathie Wood. But at that time, the Fed maintained a zero interest rate, and it started raising rates from March 2022. What that means is that the rate hikes began after the bubble had already burst. But there's one problem. Here, inflation was already rising, so raising interest rates was inevitable. It's like with bread during that same period. Stocks also rose to 229 after 16 years. At this time, zero interest rates remained and there was no recession, but with rising inflation, a rate hike was inevitable. That's the way to see it. If you look further down, there's a summary laid out here. The most important finding is this. If you look here, from 2020 to 2021, there was a collapse while the zero interest rate was being maintained. The key point is that you could already anticipate an interest rate hike. Because if you look at the Consumer Price Index, in January 2022, the Consumer Price Index recorded 7.5, and 7.5 was the largest 12-month increase since February, 1,982. What that means is, even though we hadn't entered the interest rate hike cycle yet, it was only natural that an interest rate hike cycle would appear. You can see it as there was no other reason for the drop except for the interest rate hikes. So, all the frenzied rallies in the United States stock market and overseas stocks shown here eventually fell because of the interest rate hikes. So even for us who are investing in AI beneficiary stocks, we only need to look at one signal. When will interest rate hikes occur? The time when interest rate hikes appear will finally be when the AI bubble bursts. I think that's how it will end. The last content prepared for today is today's United States stock video. Today, several experts from Consumer News and Business Channel present a stock market strategy guide for preparing for 2026. As you listen to what they're discussing, I think it would be good for you to make some plans for the year. That's all for today's stock news on January 5th. Thank you for staying with us until the end of the first broadcast of the new week. No one knows how the United States stock market will unfold in 2026, which is just beginning. However, I can promise you once again that I will do my best to help you as much as I can within my abilities. Let's all keep fighting together until the day we can retire through investing in United States stocks. Have a happy day. Thank you.
Jenny, happy to be with you today. As we start 2026, do you think that this year winners will continue to win and losers will continue to underperform? During 2025, the NASDAQ index rose by 20, but the WU index only increased by 13. No,
I don't think so. Ra'ayon Dionim, I believe that 2016 will bring changes and likely structural transformation as the market grows. I'm concerned not only about individual stocks, but the entire market. To be honest, I'm quite nervous right now, and the reason is more about behavioral aspects than fundamentals. A day or two ago, Bloomberg ran an article stating all Wall Street analysts now predict a stock market rally through 2026. I've worked in this industry for over 30 years, but I've never seen the market actually move as expected when everyone is thinking exactly the same way in one direction. This situation makes me uneasy because it seems like everyone is focused in the same direction. Lately, I'm often asked about the best investment for next year, and most people mention stocks like Microsoft or Amazon that have already done well. Basically, successful ideas are just being repeated. This doesn't feel comfortable to me at all. Also, many people say that the economic indicators look very good, but the economic indicators we're looking at are essentially data that reflect the past. I think people aren't looking far enough ahead into the future as we approach the new year. Last Wednesday morning, Salkin appeared on a broadcast discussing the so-called job catastrophe, employment, and apocalypse. There are about 5 to 6 million drivers in the United States alone, and everyone knows that autonomous driving and unmanned transportation, like Waymo, are coming. This is a very serious problem. He cited call centers in Indonesia and the Philippines, noting up to 80% of workers there could be laid off. Even this morning, someone else said something similar, but I can't remember exactly who it was because I was driving at the time. The fact that these warnings keep coming up feels like a signal we can't just ignore when looking at the current market. But they also said as AI grows, a 1,000-person company could replace a large consulting firm like Accenture, and a 100-person company could replace a business like SAS. Honestly, when I think about what the labor market will look like this year, I feel quite worried. People say employment remains strong and wages are high, but that view relies on past data. While there is this overly optimistic outlook spreading, on the other hand, there are signs that the labor market could become quite difficult. Also, considering that more than 60% of the United States gross domestic product comes from consumption, I start to worry about what will happen if people start losing their jobs or if they can't maintain the current level of consumption. So my conclusion for this year is that it's time to reduce some risk. The past 3 years have really been an excellent bull market. That doesn't mean I'm extremely pessimistic or that I think a major bear market is coming, but if you've already had good results, I think it's right to reduce some risk in your portfolio in some way. You could sell assets and adjust your strategy. You could move away from high-growth stocks or assets that have done well so far and shift to assets with more reasonable valuations, increase your allocation to overseas assets, or hold a bit more in bonds. The important thing is that this year's investment strategy is very likely to be different from last year, or the years before. What keeps bothering me is that when I look at the market, it still seems like everyone is riding the same old train and going along as before. It's interesting.
Are you saying we should reduce some of the risk? While Kevin Jenny was talking about the job market over at Canaccord Nut, they were saying that a few weeks at the end of 2025 will be like giving a gift to 2026. They said the economy is solid, but the labor market has weakened enough for rate cuts to continue. Are they viewing slight labor market weakness as a positive? Including this perspective, how do you see the overall economic setup in the big picture as we head into 2026, including the picture of the job market that Jenny mentioned, and also considering how the world might change as AI technology continues to advance?
Yes.
I listened carefully, and I think it's a very meaningful point, but at this moment, I'm not yet convinced that we've already reached that stage. Rather, the point I'm more cautious about is the market consensus, and at the moment, that's the most concerning part for me. So, I don't think we need to drastically change direction right away. I believe the overall environment is likely to continue the trends we've seen in 2025 to some extent, but it may not be as enthusiastic as it was back then. AI trades are still valid and are actually growing, but the growth rate may slow down compared to before. There may be 1, or maybe even 2, interest rate cuts in 2022, but it's hard to say that this will be a full-fledged interest rate cut cycle. Also, although economic growth is based on past data, it hasn't been bad so far. So, at least until the early part of this year, the environment is closer to an extension of 2025. But among Jenny's words, the part I totally agree with is that the market is no longer as easy as it used to be. It's no longer an era where just mentioning the word AI in an earnings report automatically makes the stock price soar. In some cases, there may not be any reaction at all. That's why I think stock selection will become much more important going forward, and that choosing and focusing, in other words, a selective approach, will be the key. I believe this kind of environment is ultimately a condition where professional active management can shine, and I think 2026 is a year to look forward to. Of course, I'm saying this with the possibility of volatility and a gradual upward trend in mind, but even with those factors, I believe it will be a meaningful year.
When I listen to many stock analysts, Jenny, some may feel that everyone is being overly optimistic, but in reality, there seems to be a strong consensus that the market will continue to rise. Everyone knows valuations are very high right now. Nevertheless, many analysts commonly say that now stock selection has become really important and we need to take a much more selective approach. Looking ahead to 2026, what's your view on the current state of this market?
I'd also like to say something nice about Jenny. When I did a broadcast with Jenny in the past, something she said really caught my attention, but at the time there wasn't any concrete data to show how true her words were. But since then, I've been holding on to that clue and keeping an eye on it for several weeks. The thing Jenny said, Individual investors, in other words, retail investors, are now running out of the ability to spend. So, the story was that they're selling stocks like Palantir or Nvidia, which have been rising all year, those so-called stocks that have gone straight up to the top right, to cover their living expenses. Back then, to be honest, I wasn't sure how true that was. But these days, what I'm paying the most attention to is Bitcoin. I believe Bitcoin best reflects individual investors' fear and greed. Bitcoin is a great indicator for institutional investors, but I think it's even more accurate for reading the psychology of individual investors. And the trend I started to notice was around last October, which coincides with the time when Jenny's data came out. Is it the point where long-term holders started selling their Bitcoin? A few weeks ago, Bloomberg published an interesting article. Roughly $3 billion in long-term held Bitcoin began entering the market as individual coins, not ETFs. The article said that this pace was the fastest in the past 5 years. The crypto community knows Bitcoin is typically the last asset people want to sell. Especially in a year like this, when the National Tax Service is tracking capital gains much more precisely, it's even more significant. I think it's quite meaningful that such assets are actually being released into the market and being sold, don't you think? So, connecting this to what Jenny and Kevin talked about, it's very likely that 2026 won't be a party-like market where everyone is excited and everything just goes up to the right like the past 3 years. That's why I think now is the time to seriously consider reducing risks.
Malcolm, what that was MicroStrategy. I've been keeping an eye on MicroStrategy since July, and the reason is because I saw a flow of money moving out of there. What I said that day was the same point Malcolm is making now, in the context of Bitcoin, and to me, it felt like a canary in a coal mine. To be honest, I'm not really worried about Nvidia, Microsoft, or Meta. I don't think these companies are very appropriate indicators of a turning point in the market, do you? But MicroStrategy is different. This stock reflects where most individual investors stand and suggests they're under financial pressure, with their spending money slowly running out. So the more people start to worry about the possibility of losing their jobs in the future, I think this phenomenon will become more and more obvious right before our eyes. People always ask what the black swan that will crash the market is, but I think that question itself is pretty meaningless. If it's something we're already seeing in advance, then it's not a black swan anymore. From my perspective, the biggest risk to the market is already staring us right in the face. The main risk is extreme concentration, high correlation, and the chance that AI-driven efficiencies and profits could hurt the labor market. I believe this is the most fundamental market risk today.
The start of a small dream is important. Let's plant a hopeful future together, growing little by little every day. Is there excitement blooming in your heart? Let go of greed, I won't lose this time either. The result is just a continuation of the process. Even if darkness comes, I'm not afraid. I'll hold on to Miju's hand and become the light for the unseen tomorrow. Happy investing, supporting each other's dreams, walking together down a beautiful downhill path. Happy investing together with Miju, we'll all be together until the day we boldly retire with Gupchu's dividends.